Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The first step to firing your financial advisor: embracing the you can do mindset. This is the foundation of your entire journey because it addresses the biggest obstacle: the belief that investing is too complex for regular people. The financial industry has spent decades convincing you that managing money requires some complex expertise, something only they can provide. However, this is absolutely wrong. Successful long-term investing is actually surprisingly simple, and more importantly, you're absolutely capable of doing it yourself. So let me share with you some brutal truths that the financial advisors does not want you to know. 1. Your financial advisor is likely costing you far more than you realize. That 1 to 2% annual fee might not seem like much on surface, but when you compound that cost over decades, you're talking about hundreds of thousands of dollars in wealth erosion. 2. Your financial advisor's investment strategy most likely sucks. Studies consistently show that 80 to 90% of actively managed funds underperform a simple index fund over time. You're not only paying a premium price, but you're paying it for mediocre results. Successful investing is not about picking hot stocks, timing markets, or complex strategies that require complicated calculus level math. It's about having a simple investment strategy, often built through diversified index funds, contributing consistently and staying the course through market volatility. These activities are simpler than many people make it out to be, and you're more than capable. But I'm going to make a guess here, but if you're the type of person who's willing to watch boring videos like this on YouTube, I bet you're making a lot more complex, both financial and personal decisions on a daily basis. You manage your spending, you manage your kids' school activities, and you manage what you and your family is going to have for dinner tonight. You might not believe me when I say this, but an effective investing strategy is actually a lot simpler than many of these activities. So bottom line, if you're sick of overpaying your financial advisor and you want to take control of where and how your money is invested, believe in yourself. You have the intelligence and the ability to manage your own wealth. So take action. All right, step 2. Now that you've built confidence, it's time to get tactical. Step 2 is all about preparation. This is where we want to review, research, and prepare for our transition. This preparation phase is crucial because rushing into firing your advisor without proper planning can not only cost you money, but create unnecessary complications that can haunt you down the line. Here are some activities that I recommend. 1. Review your current contract. Start by digging out your original advisory agreement and reading it carefully. This document should outline the steps you need to take to formally terminate the relationship, such as providing written notice to your advisor. Look for termination clauses, require notice periods, and any specific procedures you must follow. Some contracts require 30 to 60 days written notice, while others allow immediate termination. 2. Understand fees. Pay special attention to fee structures and potential penalties. Some fees you might encounter include early termination fees, sell charges on mutual funds when you sell shares before a specified timeline, and account closure fees. 3. Research your new investment home. If you want a simple investment strategy, the big 3 low-cost brokerage firms, Vanguard, Fidelity, and Charles Schwab, are excellent starting points. Compare their account minimums, expense ratios and index funds, customer service ratings, and online platforms. But to be honest, you can't go wrong with any one of them. 4. Identify your DIY investment strategy. The most popular DIY strategies include target date funds, maximum simplicity, 3-fund portfolios, total stock market, international stocks, bonds, or simple 2-fund approach, stock index plus bond index. Research these options and choose one that matches your risk tolerance and time horizon. And remember, you don't have to lock this in yet. Just start the process of understanding all your different options so you're prepared when the time comes to make the decision. 5. Understand tax implications. Retirement accounts like 401ks and IRAs can typically be transferred without tax consequences through direct rollovers. However, taxable accounts may trigger capital gains if you need to sell positions. Some assets transfer easier than others. Retirement accounts and tax-deferred accounts transfer very easily, but proprietary funds and some assets unique to specific investment companies may need to be sold. 6. Gather your investment records. Before firing your financial advisor, make sure to obtain records of your investments, tax documents, and account information. Request or download all your recent statements, tax forms, 1099s, and cost basis information for all your holdings. You don't want to be caught in an awkward situation where you're needing to reach back to your old advisor and ask for documents 3 years from now. It's like going back to your old girlfriend and asking if you can get that sweater you gifted her 4 years ago. Just awkward and unnecessary if you can plan ahead. Bottom line, this step is all about preparation. And don't rush it. I know, once you realize how much you've been overpaying your financial advisor, you're probably itching to transfer your money out of there as soon as possible. However, take your time so you can be thorough. Remember, you've probably been paying these high fees for years. Taking a few weeks to do it right won't hurt you, but rushing and making mistakes definitely could. Alright, but before we get into the next step, there's something really special I want to share with you. For those of you who want more hands-on support as you make the transition to taking more control over your investments, I want to let you know about an exclusive program. Introducing the Financial Tortoise community, and it is now open for waitlist sign-up. This community is your ultimate roadmap for mastering your money, systematizing your finances, and securing your family's financial future. Close to 15 years ago, my wife and I were completely broke. We not only unwisely spent all of our savings on an expensive wedding, but we were buried under $105,000 of student debt. Financial anxiety was a daily reality. We constantly worried about money because we couldn't see a path forward. Well, thankfully, by learning from some great financial mentors, we were not only able to learn how the truly wealthy manage their money, we were able to work our way through our 6 figures of student debt and eventually achieve financial peace. And I want to share everything I've learned with you through this special offer. Inside the community, you'll find a structured path to building lasting wealth designed specifically for professionals who want steady, sustainable growth without the hype or unnecessary complexity. Exactly the stuff I talk about in this channel. The Financial Tortoise community includes personal one-on-one coaching sessions with me, where we'll address your specific financial questions and create a personalized plan aligned with your goals. Step-by-step member-exclusive courses on everything from developing the right money mindset to designing your ideal investment portfolio to minimizing taxes. Monthly live Q&A calls where we dive deep into key topics and keep you accountable. A private forum connecting you with other hardworking professionals on the same wealth-building journey. Practical tools, templates, and resources that simplify your financial decision-making. And I'm especially excited to offer members a complimentary subscription to Monarch Money, a powerful financial tracking tool that helps you organize your accounts, track spending, and visualize your progress all in one place. This alone represents significant value, but it's just one of many resources you'll gain access to. However, to maintain the quality of the support each member receives, I only open enrollment a few times a year. So join the waitlist today at financialtortoise.com/community to be first in line when doors open next. Plus, as a special bonus for joining the waitlist today, you'll receive a free special gift delivered straight to your inbox automatically just for signing up. Remember, real sustainable wealth is not built overnight. It's created through slow, consistent effort that compounds over time. Exactly what we focus on inside the community. Many members have completely transformed their financial lives, and with the right guidance and clear plan, you can too. You deserve it. I would love to see you inside. Alright, with that said, let's get back to the video. Alright, we're now at step 3. Time to have the conversation and set some boundaries. When I was first dating my wife many years ago, I remember that moment when we had what we call defining the relationship talk, DTR. For me, I remember that conversation being quite nerve-wracking. What if she said no? What if she just laughed in my face? What if she told me to go away? Well, thankfully, my amazing hair did its job that day, and we've been happily married close to 15 years now. Well, when it comes to your conversation with your financial advisor, it is nowhere that serious. So nothing to stress out about. In actuality, this conversation happens all the time in the financial industry. Accounts come in and accounts go out. And it is actually in the firm's best interest to make the transition as smooth as possible because you never know when you might need each other again. But for you who've never done this before, let me give you some helpful guidance. For one, be clear. Notify your financial advisor of your decision. However, a thing to note here is you actually don't need an in-person meeting to fire your advisor. A brief email should suffice. You can just notify them that you're moving in a different direction. Communicate that you've decided to self-manage your accounts going forward. Express gratitude for their work so far and ask them if there's anything you need to provide in order to make the transition. The key is to be clear about your decision and avoid over-explaining your reasons. No need for that. It just opens the door for counter-argument, which leads to the next guideline. 2. Prepare for the sales pitch. If you're a big account, many firms will not want to let you go so easily. So prepare for the sales pitch. Some common tactics include, the market is too complex for individual investors. You'll make emotional decisions without professional guidance. We can reduce our fees. How can we keep your business? You're making a big mistake. Let's schedule a meeting. Don't buckle under the pressure. Your response should be simple. No thank you, I've made up my mind. Again, there's no need to justify your decision, so don't engage in debate about investment philosophy. 3. Handle special situations carefully. This is if you're firing a friend or a family member who's been serving as your financial advisor. My recommendation would be to approach it delicately and diplomatically. You could say something like, I value our personal relationship so much that I didn't want money affecting it, so I've decided to move it elsewhere. 4. Document everything. Keep records of all communication. This is one of the reasons why email is great. You have a paper trail of everything. If you happen to have a phone or a video conference, follow up with an email summary so you have a written documentation. This documentation protects you if disputes arise about fees or transfer timeline. Bottom line, remember that you're not asking for permission or approval here. You're informing your firm about your decision that you've already made. So stay confident. Don't feel you need to explain your decision. Don't feel guilty, and keep your boundaries firm. Alright, we're now at step 4. It's getting real here. Time to actually execute the transfer of your money. We're now in the mechanical process of actually moving your money from your old advisor to your new investment home. The step requires attention to detail and patience, but the process is more straightforward than most people expect. The key is understanding the different transfer methods and ensuring everything moves smoothly without unnecessary taxes or fees. Here are a few recommendations to best facilitate this transfer. 1. Open the necessary accounts at your new brokerage first. Before you can transfer anything, you need somewhere for your money to go. So I recommend opening all the accounts types you currently have with your advisor. If you have a taxable brokerage account, Roth IRA, and traditional IRA with your advisor, open the same account types at your new firm. 2. Understand your transfer options. Your transfer options vary depending on the type of accounts you're moving. For retirement accounts like an IRA, you always want to request direct rollovers or trustee-to-trustee transfers to avoid the 60-day rollover rule and potential tax withholdings. For your regular taxable brokerage account, you want to prioritize in-kind transfer. This means the actual securities move to your new account in kind without being sold, avoiding immediate capital gains taxes. You can then decide what to sell and when at your new brokerage, giving you complete control over the tax implications. If some investments can transfer in kind, like proprietary funds, you'll need to decide whether to sell them first or leave them behind in the old account. 3. Leverage your new brokerage's transfer services. Now, if all this transfer stuff seems complex, no worries. Firms like Fidelity, Vanguard, and Schwab have dedicated teams whose entire job is helping you transfer accounts from other firms. They want your business, so they'll do most of the heavy lifting for you for free. So leverage them if you want more hands-on help. 4. Stay patient. Most retirement accounts and tax-deferred accounts typically transfer smoothly, usually no more than a week or 2. And during the transfer period, your investments may be frozen. You won't be able to trade or make changes. Don't worry, this is normal and temporary. Just stay on top of it via your new brokerage firm. And if you have some assets that don't transfer so easily, such as proprietary funds or investment unique to your old firm, do not panic. You can choose to sell them or even leave them behind temporarily. We can always deal with them later. The important thing is that you started the process of transitioning. Now, if you reach this stage, I truly want to say a heartfelt congratulations. You've not only decided to take control of your financial future, but you actually took steps towards it. Kudos to you, my friend. Alright, now that you've done the hard part of moving your money, what to do next, let's get to our final step. Welcome to step 5. Now that your money has successfully transferred to your new brokerage account, time to convert your money to your simple investment strategy. If you're like most people who've used financial advisors for many years, the chances are you likely have a hodgepodge of expensive actively managed funds, individual stocks, and complex investment products. Well, no more of that. It's time to transform your portfolio from an expensive, complicated mess into a simple, low-cost wealth-building machine. Let me review some recommendations to make this happen seamlessly. 1. Assess your portfolio. Start by reviewing what actually transferred to your new account. Pull up your account summary and look at each investment's expense ratio. If you see numbers like 1%, 1.5%, 2.1% or higher on mutual funds, these need to go. If you see low-cost broad market index funds, you might choose to keep those if they align with your new investment strategy. 2. Execute your conversion in the right order. Handle different account types strategically. In retirement accounts like 401ks and IRAs, you can sell and buy freely without any tax consequences, so convert these first and completely. In taxable accounts, consider tax loss harvesting opportunities where you sell losing positions first to offset gains from profitable sales. This minimizes your immediate tax hit while still moving towards your simple strategy. 3. Implement your chosen simple investment strategy. This is the satisfying part. Buying your new investments. If you choose a simple one-fund strategy like a target date fund or a US total market index fund strategy, this conversion is simple. Sell everything and buy one fund. If you decide on a 2-fund or a 3-fund strategy, buy the respective funds with your preferred split. 4. Automate your investments. Set up automatic transfers from your checking account to your investment accounts. This ensures you're not just managing existing money, but continuing to build wealth consistently. 5. Establish your maintenance routine. This is essentially setting 1 or 2 times a year when you decide to check your asset allocation. That is if you have one. To be honest, if you're following a simple index fund strategy, there's going to be very little ongoing work to maintain. And if you have completed this step, you have successfully transitioned to becoming your own DIY investor. No more paying expensive financial advisors, no more relying on someone else to make investment decisions, no more settling with underperformance. You are in control of your own future. Congratulations truly if you made this transition. However, before you decide to turn off this video, let me end with a few cautionary warnings now that you're a full-fledged DIY investor. 1. Do not second guess yourself constantly. You're going to have moments, especially during market downturns, where you wonder if you made the right decision. You might think, maybe my advisor would have protected me from this drop. Or, what if I'm missing something important? Here's the truth. Your old advisor couldn't predict market crashes any better than you can, and they certainly couldn't avoid them without missing the recoveries too. So have confidence and stick to your plan. 2. Resist complexity creep. Over time, you'll be bombarded with investment ideas. New ETFs, hot industries, latest investment trends, and individual stock picks. This is how people gradually turn their simple, effective portfolio back into complicated, expensive messes. Remember why you fired your advisor in the first place. Simple, low-cost investing beats complex investing strategies over the long term. 3. Avoid performance chasing. Because you're in control of your investments, you will have the temptation to try to eke out the highest return possible. Some years, your simple portfolio will underperform flashier investments. Growth stocks might crush value stocks, or international might lag domestic, or bonds might seem pointless when stocks are soaring. This is normal and temporary. Don't abandon your balanced and simple approach to chase last year's winners. Thank you guys for watching the theme of becoming a better investor. If you want to learn from some of the best, please check out my video here where I share the wisdom of the bogleheads, the most well-respected and well-experienced DIY investors around. Until next time, all the best.